objective of many of those partnerships between large financial services firms and fintech companies is to do innovation. And one particular thing that's very important to note about innovation is that it's a probability game. So if you experiment a lot, then there's high chances of some sort of success. And Thomas Edison, I think, is in sync with that idea. He tried many times and got one thing right one time, pretty big thing, the light bulb. As you'll see, I'm obviously a fan of light bulbs. Named my company after it. But I guess the key thing to remember is that it's really a numbers game, experimentation. And you can assume that probably 9 out of 10 experiments will go wrong. So let's see what we're going to cover today. Look at the current state of play, then dive in a little bit deeper into challenges, and then I was going to try and suggest a few things that can be done to perhaps improve the situation. So let's start with state of play. I guess this slide basically summarizes why it's also difficult, right? If you look at the corporates as well, if we are supposed to do something new, maybe we can't do that because it's just too dangerous. And the startup says, well, if we don't do anything new, then that's too dangerous. So how do you get those two to work together, right? That's quite difficult. If you think about banks, and I'm borrowing here from Professor Gary Klein, who's a behavioral economist. If you think about banks and what they're good at, right? They're basically very good at reducing risk, right? They have so many different departments like compliance, audit, risk, quality assurance, that are all focused on that one factor that contributes to performance enhancement, according to this very simple equation, which is the reduction of errors. But then if you ask yourself, who's actually in charge of creating new insights in large financial services firms? I can't think of many departments that do that. Perhaps now there are some people here and there, but definitely not many of them. But then, there's hope. In 2017, and probably also in 2018 ahead, there's a strong will. Corporates and startups want to work together. And I think we can all see that. Everyone's really interested. Everyone's talking about FinTech. So that's good. But then, if you look at the situation and how different those two types of ventures are, pretty much every characteristic is exactly the opposing, right? So if you look at agility, startup has very high agility, but then the corporation is very slow. If you look at the money side of things, balance sheet or working capital, they are on opposing ends of the spectrum. You look at technology as well, right? Technology is very new often in startups. Very, very old legacy systems in those large financial services firms. And then lastly, I think what's probably most important is the culture, right? Startup culture is very fast-paced, appreciative of experimentation. Corporations are not really. So, which brings me to what I wanted to discuss with you today is how do you do a proof of concept? And I'm borrowing from Vladas here. He has this nice chart, talks about time on the x-axis and scope on the y-axis. And you can see that a proof of concept should be done in days and is a very isolated exercise. So it's a great graph, but if I may say, I think last time I tried to do a proof of concept in a large financial services firms with a artificial intelligence startup, took about 6 months to complete the paperwork. And that didn't agree of one particular clause on liability insurance where the parties disagreed massively. So I don't know. I mean, there's a lot of days, right, in 6 months. So I don't know whether I agree with that chart that I put out there earlier. But the reality is this, that it's really, really tedious to make sure that those large firms can collaborate with startups. So let's just try to understand a little bit at a deeper level why this is so problematic. Okay, and I think there are 4 different things that I would like to highlight. First one is money. Second one is related to sourcing and procurement. And then the third one is around data and data security. And the last one is around culture. So let's look at each of them individually. So the first one, about money, right? In most large firms, there's a budget cycle. Look at that graph of the budget cycle. Maybe the months are different, but I guarantee that in most large firms, it looks something like this. What does that mean? Well, it means that if you raise your project at the wrong time of the year, you can't do it, right? Because there's a process. And if you don't get into the budget cycle at the right time, it's very, very difficult to then do something for the next year. So that's one problem. Let's say you have some sort of budget approved, fantastic. But then you need to raise a project request, right? This is just an example of a normal project request process that probably exists in any other bank. It's quite tedious, right? If you just want to try and see whether a new technology has value for the bank or not, and you need to go through all of this, it's probably not the best use of your time. And then, ROI, there has to be ROI immediately. Don't know whether that's really the right way to go, because in the end of the day, you want to really try out things in the beginning and prove the concept and not create a business case. So, anyone knows who this gentleman is? He's a very, very prominent professor. And his name is Professor Altman. I'm not sure whether you've heard about Professor Altman before, but he had quite a big contribution to the world of finance and credit risk management. He teaches in NYU, and he came up with the Altman Z-score. And this is the calculation to come up with the Z-score of a company. Basically, it's a measure to estimate whether a company is likely to going to be around in the next 2 years' time. Look at that. Total assets, retained earnings, sales. Do you notice something? Basically, lots of the inputs of this Z-score calculation, a startup doesn't have. So what ends up happening is that sourcing will try to calculate a Z-score when they want to collaborate with a startup, and every other startup lands in the distress zone. So sourcing puts the foot down and says, "Thank you very much. We can't work with you. You're too new. You're not going to be around. Not possible." So that's the second kind of issue. Third one is around data and security, and that's also very interesting, because it's super, super, super important for large financial services firms to have very, very solid data protection capability. And examples like Equifax recently show that this is a very, very delicate topic. Yeah? Look at this graph that basically depicts the Equifax stock price. And you can see it recovered a little bit, but long away from recovering that whole drop that it had on the back of the data loss that they had. So I can't re-emphasize more, data and security is very, very important. And it's not negotiable, basically. That's why lots of companies come up with rather comprehensive data governance structures, such as this one, where basically from a technology level, from a physical level, from a information system level, data is managed really, really tightly. It doesn't really help to do experimentation, of course. Then let's talk about culture. If you haven't read Joy Ito's book, Whiplash yet, I can really highly, highly, highly recommend that book. Basically, what he's talking about is a bunch of principles that will help humans survive in the faster future that is ahead of us. His whole premise is that change is on this exponential curve, and that we have to start to think about things in a very, very different fashion. And I just picked out 3 of the principles to share with you today because I thought it's quite telling for financial services industry, right? So he basically says that a compass is a much more worthy tool than a map, because a map, in the end of the day, might be wrong, right? If you think about a map, it's a very, very detailed kind of tool. And a compass is more something that gives you direction broadly. It doesn't really talk about how you get to your destination. So he rates compasses much more over maps. Also, second one is practice over theory, right? So often in banks, we try to write very, very comprehensive business requirement documents. We're spending a lot of time on planning. We're trying to make sure that every other thing that we can and cannot control is accounted for. But then perhaps in a faster future is absolutely more important to practice, right? And practice and experimentation are essentially the same things. Also, huge focus in financial services on compliance. And then Joy Ito focuses on disobedience. Now, there's a caveat here, right? If you're engaged in a regulated activity, obviously you want to be more on the compliance side. But if you're in the business of trying to come up with something new and create an innovation, probably disobedience is a good thing, right? Because nobody's created anything new from following the rule book. So culture, I think, also quite a big issue. And with that, I just want to talk a little bit about what we can do going forward. So the first thing that I'd like to highlight is that I think we should talk about innovation budgets, or think about innovation budgets as if they were a call premium of a plain call option, right? So as opposed to investing the whole principal, in this case the $80, why not set aside $3 for an experiment that on the one side could expire worthless, similar to the call option, but on the other side could also give you this very, very steep payoff, right? And then in the end of the day, if you think about it, the right number, right, of that call premium is basically the number where your superior, if he asks you, what are you doing with those $3, is comfortable if you tell him, well, I'm just experimenting, right? At the same time, number has to be big enough so you can run a whole number of proof of concepts per year, okay? So that's how we think about innovation or experimentation budgets. And this is not something that is very theoretical. It's something that we've already tried and tested with customers, and it works. The second thing that I believe is very, very important is to borrow from the venture capital world, to move away from this annual budgeting process that we have in large firms. And you might have seen this curve is the curve of a startup from initiation towards an IPO. And as you know, in the beginning, there's the valley of death, absolutely no revenue. Some friends give you money, angel investors get involved, FFF get involved, friends, family, and fools. And eventually, as the company progresses and revenue goes up, they will get a number of funding rounds, right? Series A, B, C, and D, you're familiar with these terms. And the interesting thing about it is that compared to a bank, you don't get, $10 million to run with one particular exercise. But it's very milestone based, right? And your investor will say, well, I'll seed fund you. Please develop some sort of prototype and then come back to me. And then you try your prototype with your clients and then you come back to me. And you get follow-up funding if you meet those milestones. I don't see why we cannot manage innovation budgets in a similarly iterative fashion in large financial services firms. And come to think of risk, that's actually reducing risk, right? Because you can pull the plug much easier. Otherwise, what happens more than often is large amounts of money get signed off for one particular project. And then when you complete the project and you put the offering in front of the client, they don't accept it. So you've just spent a whole lot of money without any validation, and that's why we believe that learning from venture capitalist model is actually really useful to address that budgetary issue. Second, remember the Altman Z-score? The Altman Z-score is actually pretty good. And if you're trying to assess, credit worthiness of partners that you have a large contract with, it's a very, very good tool. But we have to see things in context, right? If I want to do a proof of concept for $50,000, the likelihood of that POC failing is 90% anyway. So I shouldn't be too worried about credit risk. At the same time, it's very important to understand concerns of procurement and sourcing departments to work together and figure out how you can partner with them and make them comfortable, right? The idea is that people in a room similar to this can play with a new tool, not to deploy some piece of software to 100,000 people in the company. The third one was data security. You remember that. And basically, I mentioned earlier that there's very little tolerance for error here. And that's why, what I believe is the wrong thing to do is to say, oh, we'll try to, cook our own soup and basically work around the IT security department. It's not going to work. So what we advocate is, you should, again, understand concerns of IT security teams. And if there was some sort of solution to speed up the proof of concept execution, then that's probably something that you want to do jointly with that IT security team. And the last one, right? We talk about Joey Ito and how different the culture and the mindset is in large firms. We believe that to change culture, number one, is very, very complicated, right? But perhaps one thing that could work is to try and embed innovation objectives into the performance appraisal process, right? Because if people don't have an incentive to experiment and to become more innovative, it's very, very difficult to get them there. So to take people at mass on the journey, one way to do it is to use Adobe Kickbox. If you have not heard about it, please Google it and look it up. It's basically a box that Adobe gives people for free. And what the company has to do is basically put a little check inside that red box, and then everyone can go off and execute a design thinking type process where they get to work on an idea that they feel adds value to the company. If you're interested in learning more about that, then please also feel free to ping me offline. We've got this little infographic that we shared a while ago. Happy to send that across, and maybe you find it useful for your organization. It's fun, and it can really make a difference because it's very empowering towards the employees. So with that, I kind of want to wrap up the little presentation and move on to a conversation that we're going to have with Norbert. But I wanted to leave you with this experimentation framework that basically sums up everything that we've discussed today, right? So in our view, if you want to do experimentation and lots of proof of concepts, this is how to do it. So basically you create a physical space and a technology space inside the large financial services firm that has separate IT infrastructure and a one-way data feed. So if you think about that, it's not like any data is leaving the premises of the bank, right? That's not the case. And that's the main kind of worry of all IT security departments. What happens if we share data with somebody else? Well, in this case, we don't, right? We just pump data into a very separate space, but it's still owned by the bank or the insurance company. That space is accessible to internal teams, obviously, but it's also accessible to startup companies and startup founders. In that space, startups can basically configure their systems, but none of their data flows will ever reach the normal network of the bank. There's also very lightweight onboarding, so no Altman Z-score in this case. for teams within the large financial services firms to collaborate with startups. And we believe that if you create that kind of space, you'll be able to execute proof of concepts really, really swiftly. Again, if 9 out of 10 fail and you can only do 2 a month to a year, then you probably need a lot of years, right? And we all don't have that because everything's moving so fast. So with that model, you could probably do between 20 and 50 proof of concepts, and then your probability of hitting at least 1 or 2 that might be quite successful is a lot higher. So if you want to talk about this model in more detail, then please feel free to contact me. We're trialing this with one particular customer right now, and it looks very promising. And I guess with that, I want to thank you for your attention for my little presentation. And I guess what we'll do now is we'll move on to a little bit of a conversation with Norbert.
Thank you, Dan. And if you have any questions, feel free to use the chat or the Q&A box, and we'll factor that into our conversation. Dan, the last piece that you described here, where you talked about the experimentation framework, it sounded like the corporate version of a sandbox. So we have a regulatory sandbox for many jurisdictions nowadays, especially I think Singapore is very successful with that, and it kind of feels a bit the same what you described, just kind of in an internal corporate fashion.
Yes, I guess a couple of points, right? So the first one is industry-wide sandboxes. I don't really know how successful they are. Okay, so obviously it's very good to talk about them in public. I hear from people that are applying to get into those sandboxes that it can be a process of, funnily enough, up to 6 months. So then again, if you believe like me that speed is very, very essential when you do experimentation, I'm not so sure whether the sandbox can really help with that. I guess the sandbox has value if you have a business model that is very revolutionary and there's no existing regulation to govern what you're trying to do, right? Then it's interesting. If that's not the case, I would never, ever apply to a sandbox kind of construct with a regulator. And I'd rather just apply for the license that I need to have to conduct my regulated activity. What I was talking about earlier, I think, is a little bit more about, how do you as a corporation get to experiment, right? And that has very little to do with regulation in that sense, because what I could try and do is probably, try out a new AI-based technology, right? That can, read documents and pick up the content that I need. Now that's not a regulated activity, never going to go into any sort of sandbox, industry-wide sandbox. But still, I need to do the proof of concept, right? Because I cannot just sign a multi-million-dollar deal with a company that I don't know whether it's going to work or not, because there are 12 people in a garage, right? Even if they have all PhD degrees. So I think it's very important to create that space so that large companies get the opportunity to interact with those smaller companies. And ideally, you want to do loads and loads and loads of experiments. Does that make sense?
It does. Thank you. If I'm a big company now and I'm a legacy behemoth, and I'm really in a waterfall model, in the very, very lengthy 3-year project cycle type of mode, and I want to change this now. I set it as my objective to be agile, innovative, disruptive. Probably some of the most abused terms as well that we heard. From your experience, what is kind of the best approach going about this? It seems like in the industry, we've got fundamentally 2 different models. We can try to change the organization as is, basically in place, and kind of transform ourselves, or we create kind of this innovation organization on the side that will grow kind of over time, and then try and bring these things together, which people generally describe as being bimodal. And which model works? Could both work? Depends on the organization. What is your experience?
So it's an interesting question, and we've got Steve online as well, who's kind of built these organizations twice. So Steve, feel free to disagree with everything I'm going to say, but I think there are basically three models to kind of do innovation. At least that's what I believe at the moment. The first one is that you try to make everyone in the company an innovator, right? And it's basically a focus on changing the culture and the mindset of people. A company that has that as an objective is for example, DBS Bank in Singapore, right? Lots and lots of focus on people, culture, mindset. Everyone has to be innovative. That's one model. Second model is, I'm just going to buy cool stuff, right? So if you think about organizations like City Ventures, for example, they basically scout all of these tech companies. They try to understand what are the kind of use cases in the bank, and then they try to get a double upside, right? So they'll basically fix a problem inside the company, and then they get equity upside as well through the investment if the problem that company is solving is quite meaningful. And then I guess the third type that I see is what I call business-aligned innovation efforts. And business-aligned innovation efforts might be a little bit more incremental, but at the same time, they add value rather swiftly, right? So requires perhaps people who understand a particular business line really well, and at the same time have very strong understanding about technology, how innovation works, how design works, to basically bring these capabilities to a particular business line. If you ask me, which one is it? I think if you're serious about it, you probably need all three of them. And then there's a matter of deciding in the company to which one you lean or which one you find most important. But I think you need to think about this in the dimension of time as well. So I think business-aligned innovation efforts perhaps can create something rather swiftly. Building a culture is a long-term gain, and buying companies is probably sitting somewhere in the middle, right?
Makes sense. So Steve was chiming in here, actually saying like companies buy big visions and then want to execute very, very small projects. How to reconcile and overcome that mindset?
Yeah, that's a very, very good question. I think I was trying to talk about the whole idea of looking at an innovation budget as a kind of a call option or a portfolio of call options. I think big money will only be signed off if initial value can be demonstrated. It's very difficult to reconcile those two, because often innovation is kind of the little brother of all of the other big projects that are perhaps driven by regulation. But I guess, combining that idea of call options and perhaps the more iterative way of deployment of capital can help you execute bigger projects. Now, having said that, I think there's one particular problem around incentives. And if I may, I just want to expand on that. I think there's an issue with incentives because people basically underestimate the pace of change, and therefore often think that all of the radical changes that are going to happen really swiftly, in my own view, will take a lot longer. So then it becomes a discussion around, will this change happen? Because people don't drive this kind of change, right? The people I'm talking about, it kind of happens to them. So will this change happen before or after I retire? And if I retire after, then it's a problem. But if I retire before, then I'm actually okay to continue with whatever I'm doing right now, right? And that's the case for most of the employees. Now, more recently, I've had the pleasure to work with a bank in Southeast Asia that is actually run by its owner. And then guess what? The incentives are very different, right? Because this company has been run, I think it's now the third or the fourth generation. And the incentives are such that the person who's the chairman today, his biggest worry is that in the family hallway with all the pictures, he's not the one who lost the business to Alibaba, and therefore he looks at engaging fintech companies and experimenting as a hedge against this big threat that he sees out there, because he doesn't really retire in that sense, right? He leaves a legacy. So I think it's an interesting thing to think about, because maybe we should all take a little bit more ownership, right? Especially if we get also paid in stocks. That would be my 2 cents.
So in all these innovation discussion, and especially since we're talking about financial services largely, so banks, investment banks, insurance companies, at the heart in my mind are all technology companies, right? Because you're not producing anything, you don't have any goods shipping around. In the end, it's all like bits and bytes. So in your view and your experience, what is the importance of like being technology savvy, which you can probably be at different degrees as well, but how important is the technology competence in all these innovation discussions?
I think it's very important. And I mean, there are industry dynamics that are kind of interesting to observe. So when I first started to work in banking technology in the late 90s, I think, maybe I'm just biased or something, but I thought that working in a good quality investment bank is probably the hottest thing a computer scientist can actually do. And there was a huge appetite to deploy the latest technology and be at the forefront of applying academic research in building systems inside the bank. And that was very exciting. And I think since then, what has happened is that systems became a lot more mature, more software vendors came about, and the overall kind of capability of technology went up, and therefore people started to buy more. It was less interesting for an engineer to work inside large financial services firms, so they left elsewhere. Maybe they joined Google or Facebook. And then what you see now is you're left with all these people who perhaps at one point in time were on top of their game, but are not anymore, because they're just managing vendors. And they're looking after systems that are 15 years old. So it's not really novel technology anymore. So yeah, I think we could do with more up-to-date technology and appreciation of the latest things that come out. I regularly have conversations about artificial intelligence with people, and most of the people in those financial services companies say, yeah, pattern matching, we've had that for a very long time. It's a little bit more than that, right? So I guess building some sort of broad understanding about new technologies, whether it's AI or blockchain or other aspects of data science, for example, is very important, and I don't think we have it right now.
So if I take two of your comments together, one was the kind of the retirement age and how far am I faster retiring than kind of the changes coming, or the other way around, and then kind of this non-understanding of the latest technology and having the right judgment and kind of moving much more into a vendor management role. And it seems like over the last decade, really, since the financial crisis, technology and financial services has become a cost minimization game, more or less, right? And a $500 per day cost per head is better than the $600 cost per day. And that's the only thing that is being looked at from the perspective of procurement departments. There's really no skill judgment involved. And so is ultimately outsourcing the death of these incumbents, because you're just going for volume and a low price, and in the end you get what you pay for?
Well, let me unpack the question a little bit. So I think one of the issues that is definitely there is that everything, sometimes including innovation, is about efficiency gains, right? There's basically one number that we all try to manage, and that's cost-income ratio. And rightly so, because cost-income ratio is nowhere it needs to be in 2017 on an industry-wide level. But then at the same time, I would like to suggest that while it's good to have efficiency kind of programs, one needs to set aside a little budget to do new things, right? Because it goes back to Professor Klein, right? How do you get performance improvements? Well, you can manage errors down, you can manage costs down, but what about new insights, you know? But I mean, if you look at the top line for financial services over the last 10 years, it's pretty much flat, right? So I think you want to be a successful company, you have to do both. You have to try to increase your efficiency capabilities, but then at the same time, that doesn't mean that you can just continue to execute a business model that is under massive threat anyway, right? Because with things like blockchain, for example, intermediaries are sort of pretty old school, you know, they're going to go away. So if your business is all built around just intermediating, then I think it's worth paying a little bit of a call option premium to explore what else you can do. On the outsourcing side, well, it's interesting, right? It depends who you outsource to, because there are companies that perhaps have better product development capability than a bank. So if you can find one that understands design very well, that understands the latest technologies very well, and you yourself have a good understanding of the actual problem statement or the challenge ahead of you, that can be quite strong. But I would argue that those companies are far and few, and most of them will just want you to sign a very big contract, and then you're in charge of the design part and they execute. So with those ones, yeah, that I think is very difficult.
Great. So we've got a couple of questions coming in here, hard and fast now. So from Chika, the innovation strategy discussion reminds me of a discussion around utility and purpose of art in some circles. Do you find yourself having to make thorough cases for the many ways that proposed innovation can be monetized to sway stakeholders, or do banks see innovation as a continuity measure hedge, as you described?
I love the link to art, by the way. At the same time, I would say, innovations don't need to be monetized, because the definition of an innovation is that it creates value. So if it creates value, then people will pay for it. If they don't pay for it, then it's just an invention. Then it's actually closer to art, if you ask me. Let me read that question a little bit more. So I think the main issue is that the appreciation of the importance of innovation in banking is not there. So the company that I talked about that looks at FinTech as a hedge is probably very unique because it's family owned. But if you look at the larger firms, I believe that the importance of innovation is not really understood, and therefore there's a long way to go to even have that conversation at how they look at it, because most of them pay lip service and look at it as a marketing expense, perhaps, because it's cool to have a lab, but that's pretty much where it ends. And that's why, I have very big respect for people who work in these large organizations and then just launch something that creates a whole bunch of value, or perhaps even a new business line. Which takes us to the next question, because one of those people is Steve, right? Oh, my computer died. I need to charge. Wait. Do you have a... Bin ich noch da? No. Let me see.
I think Dan's highlighting and giving me a great example of being plugged into networks, how important it is.
Dan just lost power. Let me just go over and share the screen. We'll just huddle around one screen. Yep. And we don't have Singapore British English plugs, so on the screen.
Here we go.
We're only semi-virtual. We're actually full in life in person. Here we go.
So let's look at Steve's question.
This was going down here.
Corporations blow tens of millions on obsolete tech or marketing progress to create experience for hundreds of customers versus investing a fraction of that in change the experience. Okay, so how do you engage leadership, exco, and board to shift mindset when it comes to deployment of capital? I think it's all about creating a precedent of something that worked really well. The last conversation that we had with two exco members of one particular bank, the going in position was innovation. Well, we don't need innovation in our particular business line. It's not required. And that's interesting, right? When the conversation starts like that. And I guess just disagreeing is actually quite powerful, because what we've seen is that some of the exco members usually are not so used to other people disagreeing with them. So having a very strong view and pitching for perhaps a smaller amount of money to prove that you can deliver something might be the right thing to do. That by no means says that it's an easy conversation. And I would agree that most companies are stuck in this kind of old thinking where they do pretty irrational things, if you ask me. What else is there? Richard. Thank you for this interesting presentation. Global financial services companies have a long history of introducing innovative products for their customers. How can they apply this expertise to fintech-oriented functions? So Richard, I need to throw this back to you a little bit. I don't know whether there are so many innovative products that came out of finance. So if you could perhaps expand a little bit which ones you mean, then we can have a more meaningful conversation around that. I'm just reading Steve's comment around the importance of electricity. Yeah, that is very true. Okay. Are there other questions?
Maybe I think just to switch the topic a bit, would like to talk for a few minutes about like your work on kind of the innovation index and the work you're doing there that the NYSE has licensed as well, which seems very interesting in kind of putting measures behind it and making actually innovation investable.
Okay. So it all started with a kind of newly discovered interests of mine in the space of investment management and portfolio management. And I thought, all of this creation of new value sounds a bit fluffy, right? So how do you actually kind of put a number to it? And I thought, if I can create something that allows people to invest in companies that are highly innovative, and innovation stands for creation of new value, then that should be quite interesting. So what we started to do is we try to look at how you could estimate the innovation capacity of companies based on publicly available data. And I looked at a lot of the work that other people had done, and most of it was not so satisfying, because a lot of folks are looking at innovation inputs, right? So, for example, there's one of these, most innovative lists that looks at how much R&D spend you have. And I think, R&D is actually a very interesting number, but then it's an input, right? You can spend all your money on R&D and not commercialize it very well. And then are you then innovative? I don't know. I don't think so. Similar, there's another list that looks at patent filing, right? So lots of folks, even in the academic space, look at number of patents as a proxy for measuring innovation capacity. But then again, there's other research that suggests that the most interesting business ideas and technologies are trade secrets and not patents. And also, if you look at how many patents some companies file and how many they commercialize, I have my doubts. So eventually, after lots and lots of research, we found a model by an academic in the US that came a lot closer to what we thought was more reasonable. They took a very basic equation from economics that says your output equals your SG&A times your PP&E times your R&D. And if you think about that equation and each factor having an exponent, if you resolve for the exponent of that R&D factor, then through regression analysis, you can basically estimate how good a company is in terms of innovation capacity compared to other firms in your universe. So that's in a nutshell what we do. Obviously, there's lots of hygiene factors. If you want to create a reasonable index, then it has to become very much tradable. So we have to filter out a whole bunch of companies that are, not meeting liquidity requirements. We have to make it use its compliance so that European firms can set up funds and so on. So there's a lot of legwork that has been put in around that fundamental innovation capacity estimation idea. But so far, I think we went live in May 2016, and while everyone had a good period since then in the equity markets, I think ours was just a little bit above that. So I'm very happy with it.
And so the companies that are in this index, are these the usual suspects, or
no?
So
yeah,
there's some surprises in there.
So it's interesting, right? So you do have companies that you would guess are in that portfolio, but then at the same time, there are companies in there that you wouldn't typically associate with innovation. And it's interesting. Most investment strategies start with some sort of qualitative hunch, and then that qualitative hunch is being supported by some model, right? But if you think about the work that we did, is we basically did the other way around. We came up with a very solid kind of framework of how to select those companies on number spaces only, and then we didn't really know, would that selection be confirmed by any qualitative information, right? So one thing that we saw, for example, in one company is that they won a so-called, in the US, there's this thing called R&D Oscar, okay? So R&D Oscar goes to companies that basically are do something very, very good based on R&D, and it's a steel mill company that basically optimized the process of how to process steel, and what took, I think, 2 weeks, they now do in 20 minutes.
Yeah.
So it's kind of interesting to see that now that the quantitative selection criteria are out there, it seems to be working, because these kind of things are getting picked up. And then obviously once the company announced that kind of award, stock price jumps, right? So it's quite interesting.
Wonderful. So I think we're used like almost a whole hour after all. So thank you very much, Dan. You can get used to this. It feels like the two old guys in the Muppet Show on the balcony. At least I'm the old guy. You're a bit younger. So maybe we'll do this next time in this format. So thanks very much, Dan.
Thank you for having me.
We'll take a 5-minute break, and then we'll continue with Kevin Chen, who dialed in from New York for a discussion on the IOTA Foundation. And there's Kevin coming already. But we'll still take a 3-minute break, so everybody can grab a coffee, and then we'll start with Kevin. All right?
Thanks, guys. Bye-bye. Thank you.
Hey, guys.